Hey guys, Dan here, and welcome back to my YouTube channel, Investing with Dan. Today, I'm going to discuss with you my top 5 tips for getting into investing and securing your financial future. Now, beginning your investment journey can definitely be an intimidating and daunting experience. For most people, the fear of taking the first step and possibly making a mistake is enough of a deterrent that they won't ever invest in the stock market. The reason behind making this video is that I honestly would have loved to see something like this before I plunged into the world of investing, and hopefully it saves you from making a few rookie mistakes and sets you on the right path to becoming a great investor. So, getting straight into it with tip number 1, and that is to make sure you have an emergency fund set up, and to not invest your entire life savings right off the bat. It is very important that you have a decent amount of savings tucked away, perhaps a couple months worth of wages in a saving account, just in case things in your personal life go pear-shaped. In a worst case scenario, say you lost your job or got evicted from your property. If all of your savings were tied up in your investments, then you would be in quite a tricky situation and find yourself unable to cover the ongoing living expenses of daily life. It is very tempting to use majority of your savings when investing, especially when you can find something on discount or think you can make a quick buck. Overcommitting and trying to chase gains like this can often leave you with excess stress and could even result in poor investing decisions long term. The key point here is that you only use the extra money you have to invest. In order to invest correctly, you need to make the distinction between necessary funds and disposable income. If your savings are sitting in your bank account as disposable income, it's likely to be losing its buying power due to inflation. So this would be a great opportunity to set this money to work harder for you by investing it into a diversified portfolio. My second tip, once you have your emergency fund set up, is to quite simply just start investing. When it comes to the world of long-term investing, time is much more important than money. Whether you are 20 years old or 40 years old, starting today is much better than starting 10 years later. And this is due to the power of compounding. With compounding on your side, you can earn interest on your interest and start to make your money work for you. Compounding has sometimes been described as the 8th wonder of the world. So in my opinion, it's vital that you take advantage of it with as much time under your sleeve as possible. There's a really great saying that I love to think about when it comes to starting your investment journey. The best time to plant an apple tree was 20 years ago. The second best time is today. I think that quote really highlights the importance of starting now and conquering your fears or avoiding procrastination in general. Tip number 3 is going to be setting goals and making plans. This is a crucial step, and like any decision involving money, you should have a long-term plan set up to follow and continue striving towards. This could be saving enough money to buy a house, building up a portfolio to fund your retirement, or investing for your kids' college fund. Successful people are those that set goals, short and long-term, and stick to them. Setting goals also helps you keep track of your progress and can help motivate you when you look back and see how far you've come. Whatever the goal is, coming up with a solid strategy can help you stay on track and ensure you reach your investment targets in an efficient and timely fashion. Different people have all kinds of reasons they choose to invest. Me personally is to provide myself with financial freedom and eliminate the stresses of potentially living paycheck to paycheck as I continue to age. Budgeting your money also falls under the setting goals and plans category. So make sure you allocate a small percentage of your disposable income aside and invest at regular intervals to ensure the greatest success for your investment portfolio. For my fourth investing tip, it's going to come down to diversification. This concept is important when it comes to investing because it protects your portfolio from completely collapsing when one asset class performs poorly. Let's imagine that your entire investment portfolio was invested into one specific stock, perhaps an airline company, and then something catastrophic happened to the industry that caused that business to lose tremendous amounts of money, or even force them to shut down. Well, unfortunately for you, you are going on that ride with them straight down to the bottom because of your portfolio concentration. If you diversify your investments, when some fall in value, others may rise and balance out the fall. So what exactly does diversification mean when it comes to investing? Well, the definition states, it is a portfolio of various assets that earns the highest return for the least risk. A typical diversified portfolio has a mixture of stocks, fixed income, and commodities. Diversification works because the assets react differently to the same economic event. Essentially, diversification lowers your portfolio risk because no matter what the economy does, some investments are likely to benefit. For example, when interest rates fall, bond prices rise, while shares generally perform worse. One of the best ways to diversify your portfolio includes buying shares in a variety of separate industries, such as healthcare, technology, tourism, manufacturing, and much more. Even investing outside of your home country and buying international shares can eliminate home bias and open doors to potential gains from overseas. Either way, making sure your investments cover more than a few bases can help protect you long term and is more likely to give you back consistent profits compared to highly concentrated investing. My fifth and final investing tip is to avoid trying to time the market and instead hold for the long term. This is one of the biggest deterrents for newer investors who think they can just wait for the prices to go down and then start to invest. Unfortunately, the perfect time to invest will rarely ever come, and even if it did, you most likely wouldn't see it and miss out altogether. Trying to time the market will ultimately hinder your investment plan and severely reduce future gains. Investing is not trading. With investing, the goal is to hold for the long term and ride out the ups and downs. Historically, the ups have far outweighed the downs, and as a result, global markets increase on average about 7 to 10% each year. One small dip in the market isn't going to be the be-all and end-all of your investment journey, and understanding this will instantly turn you into a better long-term investor. By regularly investing and keeping your money in the share market over many years and decades, you provide compounding the chance to take effect, and your money will work harder than it ever has before in your savings account. Taking breaks in your investment plan through trying to time the market will almost assuredly result in lost profits. After all, the market loves to make fools of us all and can be difficult to predict at the best of times. Therefore, the best course of action is to ride out the waves, both good and the bad, and never stray from your investment goals. Well, there you have it, guys. Those were my top 5 investing tips aimed at beginner or first-time investors. If you enjoyed today's video, be sure to hit like and subscribe. That way you can see all the future videos posted on this channel. Don't forget to leave a comment, and if you have any other tips, let me know down below. Anyway, that's all from me today. I hope you enjoyed the video, and I'll see you next time.